Welcome to the channel Get Rich. Today, the company we are going to analyze is ITC Ltd. So, first, let's have a look at their business and then their financials and finally the valuations. So, let's get started. So, first, the business of ITC. They are a well diversified business empire they are having. So, from cigarettes to foods to personal care, education, stationery, lifestyle, hotels, paper, packaging, agribusiness. They have a whole lot of business under their hood. So, ITC is the third largest FMCG player in India. They are one of the fastest growing food businesses in India. And if you look at the agri-business, they're the leading agri-business player in India and pioneer in rural transformation. They are doing sourcing and supply operations spread across 20 states. They are the largest procurer of wheat after Food Corporation of India. They are the fifth largest leaf tobacco exporter in the world, 43% value share of Indian exports. They are one of the fastest growing hospitality chains in India. They are leader in green hoteliering and profitability. Their paper business is number one in size, number one in profitability. They have world-class environmental performance. And the cigarette business. So they have a huge market share in cigarette business. They have around more than 70% of market share in cigarette business. So most of their revenues are coming from cigarette business. So cigarette business is a sizable chunk and also main source of profitability. Within a relatively short span of time, ITC has built over 25 mother brands, many of which are market leaders in their segments. This vibrant portfolio of brands represent an annual consumer spend of over 18,000 crore today. They have a variety of products in FMCG segment. So they are a core cigarette player 10 to 15 years back, and then they realized they have to start diversifying to many products because it's solely reliant on cigarettes. So they started diversifying to other products, and they have now products of all categories from staples, biscuits, snacks, noodles, pasta, juices, chocolates, coffee, spices, dairy beverages, milk, ghee, paneer, confectionery, chewing gums, salt, ready to eat, instant mixes, or classmate notebooks, you name it. They have a whole lot of products under their hood. So today, ITC FMCG products reach over 124 million Indian households. Then look at their brands: Sunfeast, Ashirwad, Bingo, Yippee Noodles, Be Natural, Candyman, Gammon, Savlon, Engage, Fiamma, Vival, Classmate, Farmland, Mangaldeep, AIM, Homelights, and finally now ITC MasterChef. So they have a whole lot of brands under their hood and they are growing at a much faster pace from their revenue perspective. So if you have a look at profit before tax, profit after tax, and market capitalization, so they have a highest profit before tax in a private sector listed company. So in the year 2008 and 2009, they are the 7th largest profit before tax company, and currently they are the 5th largest profit before tax company. And then if you look at the profit after tax, net profit, they have the 5th highest profitability in the private sector Indian listed space. And the market capitalization has always lied between 3, 4, 5. Let's have a look at their diversification of portfolio. In 2001 and 2, they just have one single category and less than 100 SKUs. But then in 2018 to 19, they have 40 different categories. And then if you look at the scale of distribution, they have 3 channels with 72k markets serviced. But then currently they have 10 channels with 1 lakh plus market serviced. So outlet serviced, if you look at that, 0.75 million in 2001 to 2, and currently they have 2 million plus outlet serviced. So if you look at the strength of resources, they have 6 factories in 2001 to now they have 200 plus factories. And if you look at the warehousing space, it also increased from 0.4 million square feet to 5.2 million square feet, and the throughput also increased from 0.95 million to 2 million. So we discussed they have a lot of different businesses and they have a lot of different brands. Now let's have a look at their key business segments. How much revenue is coming from which businesses? So if you have a look at their revenue breakdown, so 41.4% of their revenue are coming from cigarette business. If you look at the FMCG other than cigarette, so they have around 26% is coming from FMCG. Hotels 4.3%, agribusiness 16.3%, paper and packaging 12.1%. So this is the revenue breakdown. So if you go to their bottom line, cigarette remain the biggest profit generator of the company. So cigarette accounts for 83.5% of their profitability. FMCG is just 2.4%. Hotels is 1.9%. Agribusiness 4.7%. Paper and packaging 7.4%. So most of their revenues are coming from cigarettes. That's the main problem. We will talk that in detail when we discuss about the cigarette business. So let's talk about each of their businesses. So first comes cigarette business. So out of all the tobacco products, legal cigarettes accounts for 11% of the total tobacco consumption in India. So other tobacco products is 89%. So if you look at the tax revenue by these segments, so legal cigarettes accounts for 87% of the revenues, but then other tobacco products only 13%, even though they account for 89% of the revenue or the market share, but only 13% in the tax income. Why this is happening? So why is this discrepancy? So the tax incidence on cigarettes has nearly tripled between 2011 and 12 and 2017 and 18. And taxes on cigarettes are effectively about 55 times higher than taxes on other tobacco products on a per kg basis. So this leads to a lot of illegal cigarette markets. So the legitimate cigarette industry has declined steadily since 2010 to 11 at a compounded annual rate of over 4% per annum. At the same time, illegal cigarette volumes in contrast have grown at a nearly 5% per annum during the same period, making India one of the fastest growing illegal cigarette markets in the world. According to Euromonitor International, India is now the fourth largest illegal cigarette market in the world. Discrepancies in taxation on tobacco products has caused a progressive migration from consumption of duty-paid cigarettes to other lightly taxed, tax-evaded forms of tobacco products, comprising illegal cigarettes and BD, chewing tobacco, gutka, sarda, snuff, etc. It is estimated that on account of illegal cigarettes alone, the revenue loss to the government is more than 13,000 crores per annum. So these are all the problems ITC Limited has to face because their cigarette volume is degrowing from the year 2011. So it is making more and more difficult for the company because they are increasing the taxes and then they have to bear lot of burdens and they have to pass on the price increases. So this is causing pressure on ITC Limited. That's why a lot of people are seeing uncertainty in ITC Limited, and that's why it is reflecting in the valuation. So if we compare the per capita consumption, India remains one of the lowest compared to other countries like Russia, Japan, China, USA, Pakistan, Nepal and Bangladesh. But then at the same time, if you compare the affordability of 2000 cigarettes, it's the highest. So India has very low affordability of cigarettes. So they have very huge taxation on cigarettes. So that's the main problem for the legal cigarette industry. So let's have a look at cigarette volume growth. So from December 14 to December 15 or June 16, the tobacco volume degrew by 15%, 13%, 17%, 15%, and then it started increasing by 1%, 3%, 4%, and again it dropped by 6%, 4%, 3%, and in the recent times it increased by 6, 8, and 9%, and again it starts decreasing. So more and more people are shifting from legal cigarettes to illegal cigarettes or other form of tobacco products. So if you look at the cigarette EBIT of ITC Limited, it is constantly increasing. So that means they have a lot of pricing power. Even though government puts more and more taxation, they are passing on the prices to the customer. So cigarette EBIT growth is also always on the positive territory. It varies from 2% to 10%. So it's on the growth. So even though they cannot maintain huge growth, but still even with a lot of taxation, they can still maintain very good profitability because they have the pricing power. And the product like cigarettes, they have a kind of stickiness. So even though they increase the price, the customers are buying this at any price. So that's the one advantage they have. Then if you look at the cigarette price growth, they increased the price from 16 to 17% from December 2014 to 15, and then 3, 4, 5% during 15, 16 and 17, and then they increased from 8, 9, 10% until June 18, and recently they increased by 2 to 3%. So they are constantly increasing the prices. So these are all about the cigarette business. They have cigarette business contributes a lot to the company, but then they started to diversifying to other businesses, like they want to increase the FMCG share of revenues, but then it's still in the nascent stage, because even though they could increase FMCG business to 25% of the revenues, but then the profitability still remains 2.5%. So that's still very, very small compared to the profit they are getting from the cigarette business. Let's have a look at their FMCG business. So ITC has sustained its position as one of the fastest growing FMCG business in the country. So during 2018 and 2019, ITC launched over 50 new FMCG products across categories. So if you look at the revenue from 2008 to 9 to 2018 to 19, so last 10 years they increased their FMCG revenue by 4 times. So that's a very, very huge thing. They increased from 3,000 crores to 12,000 crores in last 10 years. That's a huge scale up of business. They are still scaling up their FMCG business. They want to diversify, so they want to be a FMCG company instead of a cigarette manufacturing company. If you look at the FMCG revenue, so from quarter on quarter, quarter 1 financial 16, they have a revenue of 2,178 crores. In last quarter, they had around 3,312 crores revenue from FMCG. So also, if you look at the FMCG revenue growth, so they had around 12% in quarter 1 financial 16, and it varies between 3% to 12% quarter over quarter. So it's a very good growth. They are growing, their FMCG revenue is growing at a very fast rate than their cigarette business. That's always very good for the company. But at the same time, we have to look at the EBIT, how much revenue they are converting it into a bottom line. So if you look at the EBIT in quarter 1 financial 16, they are still loss making. In quarter 3 financial 17, even though they made some profits in between, still they are loss making. In quarter 1 financial 18, they made a profit of around 5 crores, the previous quarter 56 crores, and then thereon they are increasing their revenue steadily. So in the last quarter they made a EBIT of 108 crores. So if you look at their EBIT growth, so it is growing at a faster pace because of a small base, and also they are just turned into profitable business, and they are increasing their EBITDA margin at a higher pace. As I said, if we take their revenue increase from financial 17 to 19 and their segment EBITDA increased from financial 17 to 19, so their revenue increased by 1.24x, but then their EBITDA increased 2.6x. That means their EBITDA margin is expanding. So that's very, very good for the company. Their EBITDA margin currently stands at around 4.5% or 5%. In the last quarter, they increased to 7.7%, I guess. That's a very, very good thing for the company. They are just rising because they were spending a lot of marketing, and they are promoting their products. They are introducing a lot of new products, so they are investing a lot, but then they are going to reap their fortunes in the coming year. Then if you have a look at their EBIT margins, so in financial 2011 they are making a loss of 6.7% EBIT margin. Financial 14 they just turned profitable at 0.3% EBIT margin, and then from there on they are constantly increasing their EBIT margin. So EBIT margin is nothing but operating profit margin. So their OPM is increased to 1.4% in financial 2018. In financial 2019 it increased to 2.5%. Financial 20 it is increased to 3.3%. 21 4.2% it is expected, and then 2022 it is expected to reach 4.7%. That's a very good growth. They are increasing their EBIT margin. So if you look at the industry, they are having around 15% to 23%. If you look at the industry leader like HUL, they are doing operating margin of around 23%. So they have a lot of headroom to grow. They can increase their FMCG revenues, and also they can increase their FMCG profitability to a huge level. And then if you look at their products, they built a very huge portfolio with lot of market leaders. So first, if you look at Ashirwad Atta, they have around 4,500 crores of sales. If you look at Sunfeast, it's 3,800 crores. Classmates 1,000 crores. Yippee Noodles 1,000 crores. Bingo nearly 2,500 crores. Vival 500 crores. Mangaldeep 500 crores. Candyman 500 crores. These are all huge brands. Ashirwad is number 1 in branded atta. Sunfeast is number 1 in cream biscuit. Bingo is number 1 in the bridges segment of snack foods. Classmate is number 1 in notebooks. Yippee is number 2 in noodles. Engage is number 2 in deodorants. Piyama is number 2 in body wash. Mangaldeep is number 1 in Dhoop segment and number 2 in Agarbattis. They are all market leaders. So if you look at their FMCG revenue product mix, so Ashirwad remains their biggest pie in their product. So they have around 28% of revenue for FMCG, and then Sunfeast 23%, Bingo 15%, EP 7%, confectionery 4%, classmate 6%. They also have Vival, Mangaldeep, Engage, Safety Matches, Fioma. Yeah, they have other very good brands as well. Also, if you look at the FMCG per capita consumption, if you compare India with other countries, so if India is 1x, Indonesia is consuming 2 times as India, China is consuming 4 times as India, Philippines is consuming 5 times as India. So we have a huge growth headroom for FMCG. That's why all the FMCG companies are trading at huge valuations. If you look at their new launches, so they have a very good brand like Ashirwad in Atta. They are expanding to other products. They introduced Ashirwad Salt. Ashirwad Salt gained traction in key geographies and posted strong performance during the year. They also introduced Ashirwad range of spices. They also introduced Ashirwad dairy products like curd, dahi, paneer. So in the branded spices category, the Ashirwad range of spices registered robust revenue growth. New blended spice variants were launched catering to regional taste and preferences such as chicken 65, mutton chukka masala in Tamil Nadu and garam masala in Uttar Pradesh. So they are doing a lot of expansion in all over India. They are increasing their brand presence in many categories of products. So they recently acquired a spice company called Sunrise. So the announcement came, and it's a very good thing. They also acquiring companies because they have a lot of cash reserves. So they are also acquiring new companies and growing their market presence. They also entered into Sona Masuri rice and under Ashirwad brand. They entered into frozen snacks, frozen foods, and they have introduced new variants in Candyman. And they have a brand Fabelle for premium chocolate. They also introduced new variants, and they are also doing a lot of new products in Engage, Fiamma, Chamis. They also entered into healthy foods. Like they also launched Ashirwad Nature's superfood range. They introduced ragi flour, multi-millet mix. They introduced Ashirwad gluten-free flour. They introduced ITC MasterChef Super Safe prawns, or Ashirwad sugar release control atta, Ashirwad atta with multigrains. They also introduced farmland low sugar and antioxidant potatoes. They introduced Sunfeast A2 cow milk biscuits. So they introduced a lot of different healthy food categories for the rising awareness of people. If you have a look at their agri business, their EBIT growth recorded was 7% with EBIT margin declining by 15 bips at 10.2%. So their agri revenue was declining in the financial year 14 to 16, and then it was increasing in the recent years. So they have an initiative called eChopal, the portal which the farmers can register and they can procure directly from the farmers. So they have 4 million farmers empowered under this initiative. And then if you look at their agri business, they have a synergy with their FMCG business, because their Ashirwad atta, where do they come from? They come from their agri business. They procure from directly from the farmers with the agri business like wheat, potato, fruits, and they make synergy out of it. So they have a vertical integration. So they directly procure wheat from the farmers, cutting cost, and then they made into value added products like Ashirwad. They procure potato and they made it into bingo potato chips, and they convert fruits into fruit pulp and they sell juices under Be Natural brand. They also do have a lot of spices with Ashirwad, ITC MasterChef, and they also procure milk and they entered into dairy products as well. So they have a lot of good synergy. Also they have a hotel business and they can use their own products in their hotels. So that's a very good thing. They have a lot of synergy with business with each other. And then if you look at their paper revenue growth, so they have a muted growth from financial 14 to financial 18, and recently they are doing their paper businesses growing at a higher levels from December 2018 to December 2019. And then they have a lot of different products. So ITC's B2B brands like Cyber XL Pack, Sapphire Graphic, Hearty Lumina, Omega Bar, Indobev, Neo, Wheat-based Pharma, Print, and Opaque Tissue, among others, are differentiated products meant for specific packaging and graphic usages. So ITC Hotels is one of India's largest and fastest growing luxury hotel chains, offering comprehensive hospitality solutions through more than 100 iconic hotels in over 70 destinations in the country. They have a very good profitability by leveraging world-class infrastructure and capability with iconic properties, iconic cushion brands, loyalty programs, and also they recently they changed their approach into asset-light approach, because they also want to manage other properties. They entered into welcome hotel brand proposition sharpened for management contracts in 5-star segment. So they also entered into managing other properties. So they are changing their business strategy. So that's a very good thing. So the hotel revenue was doing nice from December 2014 to June 2016, and then it was not growing that much, but from June 2018 they are doing very good. If we compare different business, so they have a different business. So if you can compare different EBIT margin, Cigarette business has a EBIT margin of 70.7%. Look at the EBIT margin they have. They have a very profitable business. And then comes FMCG other. It just has 3.2%. And then hotel business is 15.8, agri business is 10.2, paperboards, packaging and paper is 21.5%. Their FMCG other segment is not doing that great. Their EBIT margin is just 3.2%, but then they have a very huge room to grow their margin in that space because they are just introducing a lot of products and then they are spending a lot to increase their brand awareness. Once they have their foothold, they can increase their margin very good. And then if you look at their manufacturing facilities, they have manufacturing facilities all across India. They have in Mysore, they have in Karnataka, Maharashtra, West Bengal, Assam, Punjab, Tamil Nadu, Telangana and Tamil Nadu. They have 9 commercialized plants and there are 2 which are under construction. They also have R&D, very good R&D center. So ITC's strong portfolio of world-class brands and products is supported by cutting-edge research and development executed by the globally benchmarked state-of-the-art ITC Life Science and Technology Center in Bangalore. This center is working on game-changing R&D, driving science-led product innovation with a world-class team of over 350 high-qualified scientists. In a short span of time, over 800 patent applications have been filed from the center. If you look at their distribution channels, ITC's unmatched distribution network, which facilitates availability of its products in over 6 million retail outlets directly and indirectly across various trade channels. So the company sustained its leadership position in the convenience channel while consolidating its market standing in premium grocery outlets and in the modern trade channel. So if you look at the modern trade channel, if you look at in the picture, they also have a lot of modern trade channel in the supermarkets. They have a lot of e-commerce presence as well. They are present in itcstore.in, classmateshop.com, ITC Masterchef at bigbasket.com, freshmenu.com, and they also present in Amazon Pantry, and they have a lot of online presence as well. Also, they also have a presence in airports, railway stations, airlines, corporate parks. They also have their automatic vending machines with their products. So that's also a very good thing for advertisement and also selling some products. So they also have a lot of apps to engage their customers and have stickiness. So if you look at the growth opportunities, India has the lowest median age in the entire world. So look at the consumption story which is coming in for the next decades or decades to come. And also we have a growing urbanization. So in 2020, 35% of people are urbanized, and in 2030 it's going to be 40%, in 2050 it's going to be 50%. So we have a growing urbanization. That's a very good thing for the company. So also if you look at the opportunities in their FMCG business, so their FMCG opportunity is around 13x opportunity. So we can have a look at the brand by brand and then their presence and then their possible expansion. So first, if you look at Ashirwad, they have a current presence in wheat, ghee, spices, instant mixes, ready to eat, rice, milk, curd, paneer, salt. They can possibly extend to pickles or grains like wheat flour, semolina, gram flour, and distribution expansion of new launches. And then the estimated market size is around 15,000 crores, and they currently have a market of 4,500 crores. So also Sunfeast, they are available in biscuit, cookies, cake, and beverage. The current market share is 3,800 crores. But then the market opportunity is 59,000 crores. Also look at Bingo. So the opportunity of market size is 21,900 crores, and then they currently have 2,500 crores. So Epi, so that they have around 15,300 crores market size. Currently they are having 1,100 crores. Minto, Candyman, Gumman, the market opportunity size is 4,080 crores. They currently have 600 crores. B Naturals, juice market, they have a opportunity of 2,000 crores. Currently they are having 480 crores. So chocolate segment, 8,000 crore opportunity, they just have 15 crores. Sunbeam, coffee paste, so they have around 1,500 crore opportunity and currently they have 10 crores. And if you look at the personal care segment, Piyama, they have the estimated market size of 2,000 crores. Currently they have 360 crores. And if you look at soap bar, shampoo, deodorant, perfume, so they have a huge opportunity in personal care, home care, and also they have a huge opportunity in the classmate like notebooks and stationery products. So that's a very good thing. The estimated market size is around 10,000 crores. They just have 1,000 crores. So the opportunity they are operating in, they have a huge presence in all different categories, and the opportunity which is 10-13x in the foreseeing future in the next decades. So it's a very good thing for the company. If they can scale up, that's very good for the company. And also if they can increase their margins, currently they are just 3.2% margin, but if they can grow into a low double digit number like 10, 11%, 12%, it's a very, very good thing for the company. If you look at their financials, so sales in March 2008, they have around 14,600 crores. In March 2019, they have around 48,350 crores. So if you look at the net profit, they have around 3,158 crores in March 2008, and currently they have 12,592 crores. If you look at the dividend payout, they have a very good dividend payout over the years. Like from March 2008, they have around 40%. They consistently provided dividend payout like 42%, 92%, 69%, 56, 55, 73, 56, 56 and 56. And recently they said they are going to provide a higher dividend payout of around 80% of their net profit they are going to provide as a dividend. So it's also a very high dividend paying company. So it's very, very good thing for the shareholders. Then if you look at the revenues from quarter over quarter, they have consistently increasing their revenues. If you look at the EBITDA, they consistently increase their EBITDA. So their EBITDA growth varies a lot from 2% to 12%, but they are having a very good positive trend. They are going steadily over the years. And then if you look at their profit after tax, their profit after tax is growing very good. And if you look at the profit margin, it consistently increases. They have a profit margin of around 25% and they consistently increase around 30%. Currently they are standing at around profit margin of 30 to 32%. So it's a very, very good thing for the company. Even though they provide a lot of taxation on cigarette business, most of their profitability is coming from cigarette business. Even then they can increase their profit after tax margin. So that is very, very good for the company because they have a lot of pricing power. And then if you look at their balance sheet, so they have a total asset of around 17,775 crores in March 2008, and March 2019 they have around 71,739 crores. So their investment is ranged around 25,000 crores. They have no debt. That's a very, very good thing for the company. And their ROC lies around 40% in 2008, and currently they have a ROC of 35%. So their return on equity, it stays around 20 to 27%. So currently it's around 22%. And if you look at the free cash flow, so the first is free cash flow. So in 2017 they have a free cash flow of around 7,500 crores. In 2018 around 10,000 crores, 2019 around 9,000 crores, 2020 9,000 crores. Look at the free cash flow generation. They are generating 9,000 crores of free cash flow every year. Look at the cash they are getting. That's a very, very, very good free cash flow they are having. And if you compare the free cash flow with the net income, so they are having around 70% of net income they can convert into free cash flow. In 2015 it increased to 75%, in 2017 it's 72%, in 2018 it's almost 91%, 2019 it's 75%, and 2020 it's around 65%. So they are generating a very good free cash flow. And if you look at the shareholding pattern, so they are a professionally managed company, so they have no promoter holding. So mutual funds holds around 9.94%, FII hold around 14.65%, and other institution hold around 32.52%. If we compare FII plus DII holding, it increased from March 2019 to March 2020. It's marginally increased. So if you look at the valuation, ITC traditionally ranges at a PE of 25, or it varied between 25 to 30, and sometimes it even shot up to 40. But then usually it stayed at the range of 25 to 30. Currently the market punished them so much because of their cigarette business and a lot of taxation uncertainties, and they put the ITC with a lot of devaluation, and then they reached around 15 PE. They are trading at around 15 PE. So let's look at the valuation of ITC. So if you look at the revenues, in financial 2018 they have a revenue of 43,450 crores. In financial 2019 48,350 crores. Financial 2020 51,000 crores. Financial 2021 I am expecting 55,000 crores. 2022 60,000 crores. 2023 66,000 crores. I am expecting a revenue growth of around 8.4% for 2021, 9.4% 2022, 9.5% 2023, and net profit 11,220 crores in financial 2018, 12,786 crores financial 2019, 15,791 crores in financial 2020. And also I am projecting a net profit growth of around 6.3% 2021, 9.5% 2022, 10% 2023. So if we value the company with the current valuation of 15, In 1 year, the price would reach 205 rupees, 2 year 224 rupees, 3 year 247 rupees, with a price cumulative growth of 10% for 1 year, 20% for 2 year, 32% for 3 year. But then they have a FMCG business as well. Usually FMCG business trade at a much higher multiple than this, but then they are trading at very cheap because of their cigarette business, and lot of profits are coming from cigarette business. So a lot of people are telling, just looking at their current FMCG margin and current FMCG value, they are saying, okay, they are a lot of cigarette dependent company, and then so that's why they have a lot of uncertainties. So I feel their FMCG business is going to do well in the next decade, and they can increase their FMCG margin to around 10 or 12 or 15%. So if they can do that, if they can increase their FMCG by even higher in the next decade, if they can grow their FMCG revenue from 12,000 crores to 48,000 or 50,000 crores, then they can get a sizable chunk of profit from FMCG business. Then they can trade at a much higher valuations. I believe they are going to have a re-rating. I am valuing this company at PE of 24, so I'm not valuing at the whole FMCG company with the 40-50 PEs. So I understand they have a lot of cigarette business, and a lot of uncertainties coming with the cigarette business. So cigarette companies have usually have a PE of around 15 to 16. So currently they are having 15 to 16 their competitors. So looking at their FMCG business as well, considering their FMCG business, so I'm valuing the company at 24 PE. So with 24 PE, they have a 1 year price estimate of 328 rupees, 2 year 359 rupees, 3 year 395 rupees, with the price cumulative growth of 76% for 1 year, 93% for 2 year, 112% for 3 year. So you can double your money in 3 years. But then there is a slight risk because they have a cigarette business and government is increasing taxation like anything. So there is uncertainty in this kind of scenario. But then I am quite confident with their FMCG business, and then they can scale it well in the upcoming future. Also, I also valued this company with each individual businesses. For example, cigarette business, FMCG business, hotel, agri, and paper with EV to EBITDA. So the price target came at around 360 asset. So if you are looking for a cheap FMCG company with a huge future prospect, you can consider buying this company, but also understand that they have a sizable chunk of business coming from cigarette. Also, they have an intent to grow their FMCG business because 80% of their investments are in FMCG business, not in cigarette business. So that explains the intent of the management to increase their FMCG business. So that's all for today. Thank you for watching and have a nice day. If you like the video, like, share, and comment. Also, if you want me to analyze any other companies, comment in this video. Thank you. Bye bye.